The rich don't gamble on individual stocks. Instead, they follow a quiet, consistent, and powerful investing method that outperforms most Wall Street pros, and the best part? You can use it too, even if you're starting with just $100. Let's break down the truth about index fund investing, why it works, and how you can use this simple strategy to build long-term wealth. Are index funds the secret to getting rich? In this video, we'll dive into the world of index fund investing and explore whether they can really help you build wealth over time. From understanding how index funds work to their benefits and drawbacks, we'll cover it all. Whether you're a seasoned investor or just starting out, this video will give you a comprehensive guide to index funds and help you decide if they're the right investment strategy for you. So, is it time to get rich with index funds? Watch to find out. Why the wealthy don't buy individual stocks. Most beginner investors think the way to get rich is by picking the next Amazon or Tesla, or by timing the market just right. But wealthy investors, including billionaires and financial institutions, think very differently. They understand that picking individual stocks is risky, emotional, and unpredictable. They avoid chasing short-term profits and instead rely on proven, long-term strategies that reduce risk and maximize compounding returns over time. For example, imagine putting your money into a startup that promises to revolutionize clean energy. 6 months later, the company faces regulatory issues and goes bankrupt. Your investment is gone. Now imagine instead, you place that same money into an index fund like the S&P 500. Even if one or two companies falter, others like Apple, Microsoft, or Johnson & Johnson are there to carry your investment forward. This concept of broad exposure, safety through diversification, and long-term consistency is why the wealthy prefer index funds. What is an index fund and how does it work? An index fund is a type of mutual fund or exchange-traded fund that is designed to replicate the performance of a particular market index. This could be the S&P 500, NASDAQ 100, or other indexes that represent various sectors of the market. Instead of trying to beat the market, index funds aim to match it, and that simplicity is where their power lies. When you invest in an index fund, you are essentially buying a piece of every company within that index. For instance, the VOO ETF tracks the S&P 500, so owning it means you indirectly own shares in 500 of the largest companies in the United States. From major tech firms like Google and Meta to consumer giants like PepsiCo and Walmart, you're automatically diversified across different industries. The key advantages of index funds include automatic diversification, meaning your risk is spread out over many companies, very low fees, which means more of your money stays invested, and no need to pick winners and losers, because the market as a whole tends to grow over time. Index funds versus mutual funds. While both index funds and mutual funds offer diversification, their management styles are different. Mutual funds are actively managed by professional portfolio managers who try to beat the market by picking stocks and timing trades. This management comes at a cost. Mutual funds often charge annual fees ranging from 1 to 2%, which may not sound like much, but can significantly eat into your returns over time. In contrast, index funds are passively managed. They simply track an index without trying to outperform it. As a result, they come with ultra-low expense ratios, sometimes as low as 0.03%. Despite being cheaper, index funds often perform better than actively managed mutual funds. For example, between 2008 and 2018, only 24% of active mutual funds managed to beat the S&P 500, according to data from S&P Dow Jones Indices. That means over 75% underperformed the very index they were trying to beat. Warren Buffett, one of the most successful investors of all time, has repeatedly advised everyday investors to put their money in low-cost index funds rather than trying to beat the market with stock picking or mutual funds. What is an ETF and why it matters? An ETF, or exchange-traded fund, is a type of index fund that trades on stock exchanges like a regular stock. Unlike mutual funds, which are priced only once at the end of the trading day, ETFs can be bought and sold at any time during market hours. This provides investors with flexibility, liquidity, and ease of access. For instance, by purchasing a share of the VTI ETF, Vanguard's total stock market ETF, you gain exposure to almost every publicly traded company in the United States, from mega-cap corporations to small-cap startups. This means that with just one investment, you get a broad slice of the entire market. Types of indexes and how to choose. Not all index funds track the same market. The S&P 500 tracks large-cap companies, while others focus on different market segments. For instance, the total market index includes large, mid, and small cap companies. The Nasdaq 100 focuses on top tech companies. The Dow Jones Industrial Average tracks 30 of the largest blue-chip corporations. Choosing the right index depends on your goals. If you're looking for tech growth, a Nasdaq-focused fund might suit you. If you want exposure to the entire US economy, something like VTI gives you that. For long-term balanced investing, the S&P 500 is often considered a reliable benchmark. Sector ETFs. Sector ETFs allow you to invest in specific areas of the economy. For example, technology-focused ETFs like VGT or XLK let you target companies such as Apple, NVIDIA, and Microsoft. Healthcare ETFs like VHT or XLV give you exposure to major pharmaceutical and biotechnology companies. Real estate ETFs, such as VNQ, allow you to invest in commercial real estate without owning physical property. These funds offer a way to invest thematically while maintaining diversification within that sector. For instance, instead of managing a rental property, VNQ provides income from dozens of real estate investments, often with monthly dividends. Thematic ETFs. Thematic ETFs focus on future trends and innovation. These include areas like artificial intelligence, robotics, clean energy, and aging populations. Examples include BOTS, which invests in robotics and AI companies, ARKK, which focuses on disruptive innovation across multiple industries, and OLD, which includes firms that benefit from aging demographics. These ETFs are ideal for investors who have a strong belief in a specific trend or want to diversify into areas with long-term growth potential. The ABB strategy, always be buying. Always be buying refers to the practice of consistent investing, regardless of market conditions. This technique, known as dollar-cost averaging, involves investing a fixed amount of money at regular intervals, such as weekly or monthly. By doing so, you buy more shares when prices are low and fewer when prices are high, which averages out your cost over time. This helps you avoid emotional decision-making and builds a disciplined investment habit. What can you expect long-term? Historically, the S&P 500 has returned an average of 7 to 10% annually after inflation. This makes it one of the most reliable long-term investment vehicles. For instance, if you invest $500 per month for 30 years at an 8% return, your portfolio could grow to over $680,000. This is the power of compound interest, where your gains generate their own gains. Even small, consistent contributions can grow into substantial wealth over time when invested in index funds. Final tips and legal disclaimer. While index funds are powerful tools for wealth building, they are not without risks. Markets can decline, and not all index funds perform equally. It's essential to research the fund's composition, understand its fees, and evaluate its long-term track record. Use trusted platforms like Vanguard, Fidelity, or Schwab to access a wide range of reputable index funds. And always remember, investing is a marathon, not a sprint. This video is for educational and informational purposes only. It does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. Want to invest without stress and grow your wealth over time? You're in the right place. Subscribe for weekly investing tips, smart strategies, and insights to help you build long-term financial freedom, whether you're just starting out or looking to level up your portfolio. Comment below with your favorite index fund or ETF. We'd love to hear your picks. Like this video if you found it helpful. Share it with a friend who's ready to take control of their financial future. Watch next. Insert link or title of related video here to keep learning and start making smarter money moves. Your journey to financial freedom starts today. Let's grow together.